After studying this module, you will be able to learn the concept of segment reporting, evaluate the benefits and cost of segment reporting, know the major regulations on segment reporting around the world, explore the key differences between Accounting Standard 17 in India and IFRS 8 on segment reporting, understand the basis of segmentation of a diversified firm, and recognize the important items to be disclosed in segment reports. The extent of availability of financial and other relevant information of business enterprises to investors, creditors, lenders and other stakeholders significantly determines the efficiency of capital market, the rate of capital formation and the efficient allocation of resources. Adequate and transparent disclosure is likely to have a favorable impact on firm's cost of capital, share price and market value of the firm. Thus, qualitative business reporting stimulates economic growth and development. This module focuses on segment reporting, that is, reporting of segment information. The diversification of business operations creates need for segment aggregate financial information. A diversified enterprise either carries on activities in two or more business lines or operates in different geographical areas which experience varying degrees of risk and growth opportunities. Thus, the proper evaluation of performance, risk-return profile and profitability of a diversified entity necessitates provision of segment-wise information of various products, services, industries and geographical regions. The United States of America mandated disclosure of segment information in the year 1976, while India made it mandatory with effect from 1st April 2001 for specified companies. Segment reporting is a type of financial reporting in which firms make separate information disclosures by identifying reportable operating segments. In simple words, segment reporting refers to reporting of financial information according to business lines or geographical areas in which the enterprise operates. The primary objective of segment reporting is to enable investors and other users of financial statements to properly analyze the environment in which the firm carries out business activities. The segment reports address the information needs of users and enable them to make more comprehensive assessment of firm's performance and to take better informed and rational decisions. They also assist in predicting firm's future cash flows and in determining market value of the firm. The need for segment-wise information arises from the fact that the consolidated financial statements only provide an aggregated view of the financial performance of the enterprise from all the business lines and geographical regions taken together. The lack of information to the investors leads to faulty investment decisions and inefficient allocation of resources. The segment reporting provides detailed information to investors, and that plays an important role in maintaining capital market efficiency. In India, segment reporting is governed by the Accounting Standard 17 or called as AS 17 issued by the Institute of Chartered Accountants of India. This standard is mandatory with effect from 1st April 2004 for enterprises, namely number 1, whose equity or debt securities are listed or in the process of listing, whether in India or outside India. Number 2, banks and financial institutions including cooperative banks. Number 3, insurance companies. Number 4, whose turnover for the immediately preceding accounting period exceeds rupees 50 crores. Number 5, whose borrowings including public deposits exceed rupees 10 crores at any time during the accounting period. 6, holding and subsidiary enterprises of any of the above. The Securities and Exchange Board of India, popularly known as SEBI, also encourages reporting of segment revenue, results and capital employed. Accounting to revised clause 41 of the equity listing agreement, if a company has more than one reportable primary segment as per AS 17 provisions, it is also required to report quarterly, half-yearly and annual segment information in the prescribed format. Let us now discuss the benefits of segment reporting. Many users of financial reports are interested in information about the performance of one particular part of the enterprise rather than the enterprise as a whole. The consolidated financial statements do not address such information needs for the users. Disclosure of segment information provides an insight into how value is being created by the company. It also helps to understand the company's strategy and opportunities and risks faced by the company. The Financial Accounting Standards Board, popularly known as FASB of USA, has issued FAS 131 on disclosures about segment of an enterprise and related information. The FAS 131 states that the objective of segment reporting is to provide information about different types of business activities in which an enterprise engages itself and the different economic environment in which it operates. According to AS 17 issued by the Institute of Chartered Accountants of India, the segment reporting helps users of financial statements A. for better understanding of the performance of the enterprise, B. for better assessment of the risks and returns of the enterprise, and lastly, to make more informed judgments about the enterprise as a whole. The Chartered Financial Analyst Institute also lays emphasis on the importance of segment reporting for financial analysts. It believes that the segment information is fundamental and integral to the process of financial and investment analysis in order to better understand the economic behavior of a diversified enterprise. The information in segment reports has several benefits for the reporting enterprise, internal users and external users of financial reports. Some of these are: number 1, complete, true and fair disclosure. Segment reporting involves disclosure of complete information about the enterprise and all its constituents, resulting in true and fair representation of the operating results and financial position of the enterprise. Number 2, rational decision making and efficient allocation of resources. Segment information enables users to take more informed credit and investment decisions, leading to increase in market efficiency. Number 3, reduction in information asymmetry. Adequate and detailed segment-wise disclosure in segment reports enhances transparency and reliability of financial reports and reduces information asymmetry between company and external users. Number 4, reduction in cost of capital. Segment reporting enables investors to have good quality, comprehensive and disaggregated information about the enterprise. This reduces uncertainty and enhances investors' confidence and thereby reduces cost of capital to the reporting firm. Number 5, equilibrium in market price of shares. Segment-wise disclosure minimizes uncertainties and fluctuations in the securities market, and thus share prices tend to attain equilibrium. Number 6, appropriate valuation of companies. Segmented data enables more accurate predictions and earnings forecasts by financial analysts, resulting in appropriate valuation. 7, better assessment of future prospects and cash flows. Segment reporting enables users to be able to better predict the future performance, profitability and expected cash flows of an organization. 8, identifying profitable and unprofitable segments. For diversified enterprises which operate in different lines of businesses or geographical areas, segment reporting can reveal which areas are profitable and which are unprofitable ventures. Number 9, prevent frauds and manipulations. Increased disclosures about various segments of the enterprise minimizes the chances of occurrences of frauds, errors and manipulations. Various research studies have examined the potential benefits of segment disclosures and have observed that segment disclosure reduces risk and increases market returns of reporting entities. Also, the predictions and forecasts based on segment information are more accurate than those based on aggregated data. However, the aforesaid benefits of segment reporting may not be achieved in the entirety, since companies are not required to provide information on all segments. The companies have been given discretion to identify reportable segments. This causes companies to report on few broad segments only which qualify the limit prescribed under relevant accounting standard and regulations. Thus, there is a need to amend the accounting rules suitably in this regard. Let us now move on to understand the drawbacks of segment reporting. The opponents of the segment reporting argue that disclosure of segment information involves substantial costs for reporting company, which may outweigh its potential benefits. The purported costs include two major types of costs: the cost of disaggregating the consolidated data to prepare segment reports and cost in terms of competitive disadvantage. The alleged drawbacks of segment reporting are: number 1, the investors